The Little Book of Common Sense Investing by John Clifton Bogle. Before I tell you the story of a wealthy family, the GotRocks, who own all U.S. stocks, let me give you a brief introduction to the stock market. If you already understand these terms, feel free to skip ahead. Imagine Nike is like a big pizza. The whole pizza represents the company's stock. When Nike wants to sell part of the company, they cut the pizza into slices, and those slices are called shares. So, if Nike has 1 billion slices or shares and you buy 10 slices, you now own 10 shares of Nike stock. In short, stock equals the whole pizza. Shares equal the slices you can buy. Now let's say you have $5,000 and want to invest in the stock market. You could buy shares of 1 or 2 companies, but this carries high risk. If those companies lose value, your investment could drop significantly. But what if you could invest your $5,000 across 500 or even 5,000 companies? This is where funds come in. Funds pool the money of many investors together. When you invest in a fund, your money is spread across different companies, reducing risk. If one company loses value, it won't impact your entire investment as much because you're diversified. There are 2 main types of funds. Number 1 is actively managed mutual fund. This type of fund has managers who actively pick which stocks to buy and sell based on research. They regularly adjust the stocks in the fund. Number 2 is index fund. An index fund doesn't have managers making decisions. Instead, it invests in a fixed list or index of companies, like the S&P 500, which includes the top 500 U.S. companies. The goal of an index fund is to match the market's performance, not beat it. Now let's hear the story of the GotRocks. The GotRocks family owns all the stocks in the U.S. market. Initially, they are doing well by simply holding on to their investments and letting their wealth grow over time. One day, some helpers called brokers convinced the GotRocks family that they can make even more money by trading stocks among themselves. The helpers say, "We'll handle these trades for you." This makes the family's simple investment process more complicated. As the family starts trading more often, they notice that their wealth is growing more slowly. Frustrated, the family hires more helpers called stock-picking experts to improve their situation. However, these experts also charge fees, and the family's share of profits continues to shrink. In desperation, the GotRocks hire even more helpers called the investment consultants and financial planners to help them choose the best stock-picking experts. However, these additional fees only make their situation worse. The family calls a meeting, and a wise uncle explains what's going wrong. Number 1, they're paying too much to helpers. Number 2, the government taxes the profit every time they sell a stock. Since they are trading more frequently, they get taxed more often. The uncle advises them to stop using all these brokers, experts, and consultants. Instead, he suggests they return to their original strategy, holding all their stocks without making constant changes. The family listens to the uncle. They return to passive investing, holding their stocks for the long term, and once again enjoy the full benefits of corporate America's growth. You will also enjoy the benefits of America's growth and become wealthy when you watch this summary of the book. This book provides simple rules for earning money from the stock market. Rule number 1. Think of investment as an investment in a real business, not just rising and falling numbers. Let's take the example of Coca-Cola. If you buy shares of Coca-Cola, you become a part owner of the company. You own a small portion of a real business. If Coca-Cola is profitable over the next 5 years, you will earn a profit as well. The primary source of profit from investing in stocks comes from 2 main factors. Number 1 is earnings. As companies become more profitable, their stock value generally increases. Number 2 is dividends. Dividends are payments made by companies to their shareholders, typically from their profits. The long-term returns of the U.S. stock market closely match the returns from business earnings. Since the early 20th century, the average annual stock return has been 9.6%, closely mirroring the 9.5% return from business gains. It's the underlying financial performance of the companies drives profits. To understand why stock values fluctuate daily, even when a business is performing well, imagine you own a small share in a company and Mr. Market is your partner. Every day, Mr. Market offers to buy your share or sell you more at a price he believes is fair, based on his predictions of the company's performance. Sometimes his price reflects the true value of the business, but other times he is either overly optimistic or pessimistic, leading to prices that are too high or too low. Stock values fluctuate not because the business itself changes, but because investors buy and sell based on their own perceptions and emotions. In the long term, the real performance of the business will ultimately determine the value of your stock. Focus on the real market to make sound investment decisions. Rule number 2, keep it simple. The simplest way to invest in all U.S. businesses is through a stock market index fund. Among the two popular indexes, number 1 is S&P 500. This includes the 500 largest U.S. companies and represents about 80% of the U.S. stock market's value. And number 2 is the Total Stock Market Index. This covers all publicly traded U.S. companies, including nearly 5,000 stocks in broader indexes. Both indexes have shown similar returns averaging around 10% per year. From 1968 to 2006, the S&P 500 outperformed the average actively managed fund in 26 out of 35 years. A notable example is the Vanguard 500 Index Fund, where a $15,000 investment in 1976 grew to $461,000 by 2006. This illustrates the benefits of long-term investing in a diversified index fund. Rule number 3 is don't lose money. While both the S&P 500 and the Total Stock Market Index tend to grow steadily over time, some investors may seek higher returns by investing in actively managed funds. However, these funds often charge higher fees, which can reduce overall profits. Another issue with mutual funds is their tax inefficiency due to high turnover, where the average stock is held for just 12 months, leading to frequent trading. Management fees, taxes, and commissions can significantly reduce actual returns. For actively managed mutual funds, expenses can total 3% to 3.5% per year, a detail many investors overlook. Let's imagine an 8% stock market return over 50 years. A $10,000 investment in the market would grow to $469,000. However, in a mutual fund with a 2.5% annual cost, the same investment would only grow to $145,000. This huge difference in return is caused by the 2.5% annual fee difference. A study of 355 actively managed mutual funds from 1970 revealed that only 24 managed to beat the market by more than 1 percentage point annually, proving that finding a winning mutual fund is like searching for a needle in a haystack. In the final part, the author tackles a big question. Which index fund should you choose? I mean, there are over 578 index funds out there, covering all kinds of segments. It's a lot to figure out, but the author gives a clear strategy to help you make the right choice. Some index funds have low costs, while others have high fees. Many index funds replicate S&P 500. But, for example, the Vanguard 500 Index Fund, with low fees and no sales charge, outperformed the Wells Fargo Equity Index Fund, which also replicate S&P. A $10,000 investment in Vanguard grew to $122,700, compared to $99,100 in Wells Fargo. The key takeaway is that savvy investors should prioritize low-cost index funds from reputable organizations to maximize returns. What if you think that instead of investing in a mutual fund, you could buy stock in a popular company? Let's say you might believe that investing in Apple in the 1980s would have been a great decision. If you had invested $1,000 in Apple's IPO in 1980, you would have purchased 10,000 shares at 10 cents per share. After multiple stock splits and Apple's remarkable growth, those shares would be worth around $1.75 million today. However, there's another side to this story. Kodak was a popular company in the 1980s as well. If you had invested $1 million in Kodak stock in the 1980s at around $85 per share, you would have bought approximately 11,765 shares. By January 2012, with the stock at 78 cents per share, your investment would have been worth only about $9,175. Here, the author introduces the concept of serious money and funny money. You should divide your investments into these two categories. With serious money, you don't take unnecessary risks. This is where 50% to 95% of your portfolio should be invested, typically in safe classic index funds. With funny money, which should be limited to no more than 5% of your investments, you can take risks on individual stocks.